Hello and welcome to our quarterly podcast on financial transactions and transfer pricing. Today I'm joined by Laura Valestin, a partner in our national tax practice based in Washington, D.C., who specializes in financial products, as well as Chad Clark, a director in our financial markets and real estate practice based in Austin, Texas. And I'm Bob Ritter, a principal based in Chicago, specializing in financial transactions in our transfer pricing group, and I'll be moderating today's discussion. Today's focus is on LIBOR and the final regulations released by the IRS and US Treasury, which provide tax guidance with respect to alterations to debt instruments, derivative contracts, and other contracts that replace interbank offer rates, i.e. LIBOR. Today, we'll provide a brief overview of the final regulations, highlight any changes from the proposed regulations, and provide some practical advice. So to start off, I'll flip it over to Chad. Chad, what's going on now, and why does it matter for tax?
Yeah, sure. And thanks, Bob, for having me on the podcast. So where we are today, and it's been a long LIBOR transition journey, is all non-USD LIBOR rates have really ceased to be published as of the end of last year. Now, there's a few exceptions to that with synthetic LIBORs for like GBP and Japanese LIBOR, but for the most part, those non-USD LIBOR products, the transition has already taken place. With USD LIBOR, we're in a little bit of a different place. We will continue to have the rate published through June 2023. However, for any new contracts that are entered that want to use a reference rate, those should not be using USD LIBOR. So really the purpose of the June 2023 runway is to give time for contracts, legacy contracts that reference LIBOR, to be either expire before cessation or to have more time for remediation, to move those contracts from a LIBOR rate to some sort of alternative rate. And that's really why we care for tax, is those legacy contracts that need to be remediated because they're going to exist beyond June 2023, and what that remediation effort looks like and what the tax consequences are. So as you may be aware, in 2019, there were proposed regulations that were issued because we've been talking about LIBOR transition for really that long. And at that time, there really weren't a lot of great market conventions, or there wasn't a great idea as to how the market was going to react, what was going to be the primary alternative rates being used, the successor rates for LIBOR. But those guidelines were broad, and they basically indicated that if you have a modification to a legacy contract that references LIBOR, and you modify it to add an alternative rate to LIBOR and any other associated alterations, then that shouldn't be a deemed taxable event under 1001 tax rules. That was kind of the premise of that legacy modification.
Chad, that was great, and thanks for the overview. And I think a couple of things I've heard is, generally speaking, the final regulations were considered taxpayer friendly. And so can you give us a bit of, some of the key changes from the proposed to the final regulations, and, what are they set to clarify?
Yeah, absolutely. So I would say they are generally taxpayer friendly. And it's important to understand that the intent of the regulations is really to provide taxpayers with clarity, right, and eliminate the burden of having to assess the impacts of transition where there weren't clear rules before. And they didn't want tax to be a burden to the market in transitioning from LIBOR to an alternative rate. And so there were a number of comments submitted to the Treasury and IRS after those proposed regulations came out. The one area that probably had the most commentary was around this fair market value requirement. So in the proposed regulations, there was a requirement that any modification of a legacy contract to change a discontinued LIBOR rate to an alternative rate, and any associated modifications would not result in a taxable event so long as the fair market value of that contract remained unchanged. And the idea there is LIBOR and alternative rates such as SOFR are not the same. There's a difference between those rates in that the value is not going to be the same on one day given another day.
Yeah, that's right. I mean, just to kind of help people out that aren't into this every day, right? Because there are some differences between, the sort of other alternative base rates such as SOFR, right? Which are, they're not credit risk, right? So they are kind of risk free. And there are some nuances around the fact that they are kind of backward looking and forward looking, unless there's a term structure. So there are a few nuances, I guess, that, for those people that aren't kind of into this every day need to consider about, well, why aren't they the same? And I think those are some of the questions that I tend to get from a transfer pricing perspective, is just a little bit of level setting. Well, it just kind of help me understand what the nuances are between SOFR and the LIBOR rates.
Right. And really, so with those nuances, I mean, that makes the rulemaking a little bit, or the lawmaking a little bit challenging in addressing, to ensure that there isn't any type of additional manipulation in the contract, right, that would fall outside of what is necessary to transition it from a LIBOR to an alternative rate. And the final regulations eliminated that fair market value requirement. So whereas that fair market value requirement may have been helpful in demonstrating that the modifications are only intended to transition from LIBOR to an alternative rate, it was replaced with this exceptions list. So there's a list of modifications that are excluded from the definition of a covered, or in this case, a good modification for LIBOR transition. And it hinges on the taxpayer's ability to assess the intent of the modification. So for example, if there is a legacy LIBOR contract that's being transitioned to term SOFR, and that modification involves a one-time payment that is intended to capture that value differential between the discontinued LIBOR and the term SOFR rate, then that cumulatively would be a covered modification. If, however, there's an additional payment or an additional adjustment to the spread of that contract to account for something else, right, to effectively give one party of the transaction compensation for modifying something else, like a covenant, maturity date extension, or even just to address a change in, say, the credit quality of a borrower if it's a loan, then that would be an excluded modification. And understanding that there are these excluded modifications that are not covered, and then there's covered modifications, is really what the final regs guide the taxpayer in being able to do. And the reason that they need to be able to assess those excluded modifications is they have to be tested separately. So a covered modification, or a part of a modification that qualifies as a covered modification, is not a taxable event. But anything that falls outside of that, that is an uncovered modification, then that needs to be tested separately under the traditional rules. Laura, would you like to chime in on that?
Yeah, I was just thinking, Chad, what we see a lot too with companies on that point about what's covered, what's not, is some companies actually use the list to say, I do not want a taxable event. I just want this to be a transition. So then they have to be very careful, right, about sticking to the rules and making sure they fall under the criteria so they do not have a taxable event. Whereas others look at this as an opportunity to say, well, since I'm going in here to adjust the LIBOR rate, then I may also, take the chance to update any other the covenants or other terms that I may want. And that's when you would want to make sure that they're talking with like ourselves and other tax advisors to understand, were those other changes that they're making going to create an instrument that is materially different from the original one, that they have a taxable event. And then they have to worry, or at least consider, do they have any type of gains or losses that they have to pick up as a result of these additional modifications?
Yeah, I think from a transfer pricing perspective, or I think that's kind of where all this kind of hinges together, right? You've got sort of this issue of covered, non-covered, right? And then, it comes down to comparability. I think when you look at TP and 42, right, we're kind of navigating the 1001, sort of, is it a modification? And then is it a significant modification? And then, from a transfer pricing perspective, it's trying to understand, okay, well, what is the impact, right? And so I think a lot of what we're helping companies with and thinking through is, okay, well, you need to sort of kind of go through your list and understand, what are all the types of instruments that are based on LIBOR historically, right? Or some sort of floating base. Then it's kind of going through and saying, okay, what are the currencies, right? And sort of what are the things I need to think about? Because it's, for USD, we've got these published in sort of a relief through June 2023 for, most terms, right? So there's a couple that dropped off, but for the most part, they exist, right? And so it's kind of going through an inventory and saying, okay, well, what are those? And if it's an existing arrangement, an instrument, I can kind of leave that. One option is to kind of leave that be. But for all other currencies, as Chad mentioned, right? As of the end of the year last year, they ceased to exist. So I needed to do something around that. And what do I need to do? So there's kind of this inventory aspect. And then it's thinking through the pricing, issue of it, right? Because all things being equal, given these other base rates, alternative reference rates are sort of risk free, there is a natural difference, right? And so I think some of the things we've seen, if we just use SOFR as an example, is SOFR is risk free, and there's generally it's lower than LIBOR, but you can kind of start to see the trends of like how much lower is it, right? And anywhere depending on the term structure could be anywhere from 10 to sort of 25 basis points. And so from a transfer pricing perspective, right, looking at the US rules, looking at the non-US rules, and understanding, okay, for this change, it's really a comparability decision of, okay, here's the nuance, here's the difference. If I don't sort of reprice and I go to a fallback provision, which I know we can maybe chat about a bit more, then how do I think about adjusting my spread, or what sort of things do I need to consider in order to make sure, A, I don't have a taxable event, B, just from a transfer pricing 42 perspective, I haven't, had a change of value. And so those are some of the questions and issues that kind of come up that relate to exactly what you guys are kind of helping companies with day in, day out.
Yeah, and that's right, Bob. And I'll just add, when these companies are looking at their external contracts that reference LIBOR, a lot of the legwork has probably already been done, in the sense of understanding the exposure, understanding where remediation needs to happen from a new product perspective. And as I mentioned earlier, that's probably already happened, because those new products, if they're entering into them, should really no longer be referencing USD LIBOR. But as far as the legacy contracts that reference LIBOR that will exist beyond June 2023, that don't have a fallback that is deemed adequate to the company, those are the ones that I'd say in the next 6 months to a year, the business will be looking at, how do we modify this? Are we going to add a fallback? Are we going to switch to term SOFR? Are we going to switch to a credit sensitive rate? Because there's a few of those out there. There's options, right? So the market is still kind of figuring out, and certain companies, depending on what their business is and what type of products they are determining what alternative rates they want to use. And as those decisions are being made, right, that's where tax needs to be aware that, okay, this is how we're thinking about it. And is this a covered modification? How can we get comfortable just documenting that it is, right? That's kind of what I'm hearing from my clients. That's what they're talking about as they're seeing, hey, our involvement as a tax department may need to start to become a little bit more significant as these modifications actually occur.
Chad, from my side too, I think with what I'm seeing, I think that the same sort of things come up is, tax, right, has a critical role here to make sure that, we're following the tax rules. And I think a big suggestion is just to talk to your treasury folks. To your point, they know what's going on. They're talking to their banks. They kind of know what the negotiations are like. And so having that discussion and making sure you understand. And I think the things that come up when you see the current publications today, with third-party issuances, is you'll see all sorts of things. You'll see a straight SOFR plus a margin, right? You'll see what a SOFR plus, it's a CSA or a credit spread adjustment, plus a margin. And so there's various changes that are happening. And so they'll be the ones that are closest to understand, well, how are we dealing with our banks and our third parties around this? And obviously from a transfer pricing perspective, right, as we think about, well, what are the considerations, right? A lot of times you see the difference between SOFR and LIBOR, and in USD, for example, it's maybe 10 bips, which overall isn't maybe that material, right? And so understanding it becomes a bit of a documentation exercise and sort of a decision making of, what are we doing with our banks, and how does that help inform us for these things that we should be doing internally to help make decisions around the types of adjustments and sort of things that we should be thinking about to make sure we adhere them from a 42 perspective. And from there, one area we haven't touched on, and Laura, I'm going to kick it over to you, and maybe just give us some other areas and considerations, such as things on hedging, right? And how should people be thinking about that? What are some of the impacts outside of maybe the typical loans that we've kind of most people will be thinking about that they should consider?
Yeah, and it's a great question, Bob, because the final regs do deal with hedging transactions. Specifically, they deal with two types, if you want to bucket them. There's the hedging transactions that companies use as Section 1221 hedges, where they put on a derivative and it's hedging some exposure, price, currency, interest rate exposure for their items. Then they also deal with the hedging regime that we call integration. And so there are specific regulations where you can integrate a derivative, for example, or a hedge with a specific underlying item to create a synthetic instrument. So the difference just being that under the first hedging regime, you still have two pieces of paper, the derivative and the hedged item. And under the integrated, you've now combined them to create a synthetic. And the rules under the final regs deal with both of these situations, because obviously when companies have entered into these derivatives, a lot of times, for example, with like an interest rate swap, they may reference LIBOR. And so now they need to modify that contract because they no longer want it to reference LIBOR, but some other rate. So under the final regulations, where you have these hedging relationships, not integration, there was comments that they received from the proposed regulations saying, what do we do in these situations? And under the final regs, the rules provide that if you make a modification to change the rate on the derivative contract that's a hedge of an item, then that's one, if you do it correctly under the rules, it's not going to cause you to have a taxable event with respect to that derivative. So it's not going to be treated as an exchange. And also clarifying that you don't have to re-identify the hedge as a hedge of whatever item it was originally hedging. Because otherwise what would happen is every time they would have to modify their hedge, the concern was they'd have to go back into their books and records and redo the tax identification. And thankfully, the rules, again, being taxpayer favorable, provided rules say, no, you don't need to do that. You can go ahead and modify the contract and continue to use your existing identification. Then with the integration rules, that one, people were concerned because a lot of times the rules exist to say, you can integrate the hedge and the underlying item and create the synthetic. But then there's rules called legging in and legging out. So for example, if you've got a synthetic instrument, but you change the underlying. So it is an example. You have an interest rate swap, you have a debt instrument. You integrate the two so that you had, for example, a floating rate debt before and a floating to fixed interest rate swap. When you combine them, you created a synthetic fixed rate debt instrument. The concern was that if you changed and modified the interest rate swap, would that be considered a leg out? Have you now broken the integration? And there was concern that that would happen. And the rules come in and say that they give you essentially a 90-day grace period. And they say, what you can do is go ahead and you can modify the components of your integrated instrument. And they give a grace period because what can happen is a company may, for example, modify the debt instrument at a different time than they get around to modifying the derivative. And so there may be mismatches between the two instruments for a short period of time. And they said, as long as you can cure that mismatch within the 90-day period, the grace period they allow, then you have not legged out and you still have an integrated instrument. And they also provided rules that said, if during that 90-day grace period, you wanted to enter into a new derivative to kind of cover the temporary mismatch, you can do so and integrate that temporary instrument as well. So it was very favorable to taxpayers, and it allowed them to have a little bit of flexibility to make sure that they don't have to worry about breaking their integration. Again, as long as they follow the rules, they cure everything within the 90 days, and whatever modifications that they end up making to either component of the integrated instrument, that after the modifications, they still would qualify under the integration regimes, and then they would be fine. So it was very favorable for taxpayers, and the guidance, I'm sure, at least from my point of view, very helpful in clarifying with what people would do with, when it comes to adjusting their hedges.
Thank you, Laura. That was very helpful. One other kind of question that tends to come up from a transfer pricing perspective, and then I think I'll kick it over to sort of any key takeaways we've got for the listeners. So if Chad and Laura, you want to think about that in the meantime, I think one other issue, the area that comes up is sort of lack of term structure. And so, one issue is that people like to forecast, right? So if you picked LIBOR, it was forward looking. So if you picked the 30-day, you knew what to use kind of going forward. And so one other issue that tends to come up, and I think for SOFR as an example, we've kind of taken care of this issue because we have term SOFR, right? And I think I heard stats the other day that, of the issuances that in January, 90% are term SOFR, right? So people are using this so they can do the forward looking, but not every currency has that, right? And so there's sort of things that people need to consider as far as, well, what are the ways that you can use to kind of try and figure that out? And so obviously, as this becomes more and more prevalent, this more and more this is coming out for these term structures, right? So I think for a lot of people to be aware that this will kind of get figured out over time, but there are other sources and considerations out there that people can use for resources to help with this. So I just want to throw out there because I know that's a question I get a lot. So with that, let's flip over and Chad, I'll start with you, but if you've got any sort of key takeaways for the listeners.
Yeah, Bob. So I think the key takeaway here is, we've all said it, the final regulations are generally viewed as taxpayer friendly, and they really do a pretty good job of simplifying what was in those proposed regulations without fundamentally changing too much. With that said, there still are some changes that could happen in the market with respect to, as Bob just mentioned, the type of rates being used, the way that those rates are, effectively being changed to represent a term type structure. And as those changes occur, right, understanding how the different alternative rate conventions fit within these final regulations as a tax department. So communication with the business, Treasury Department, depending on the type of entity, just whoever is making decisions on the remediation strategy, understanding that from a tax perspective so that you can document and get comfortable, what is covered and what isn't.
Thank you very much. And Laura, any other last words?
I was going to say, Chad, you covered most of the takeaways that I was thinking about, but I'll just reiterate what you said, which is making sure that you're within your company, that the Treasury and the tax departments are talking so that as those changes are being contemplated, both teams are aware of what's being contemplated, understanding the impact of them so that they can evaluate them correctly and there's no surprises.
Great, Laura. I would say, you guys have hit on all the key points. I think for me, from a transfer pricing perspective, I think what I always want to give the advice to is know what you're doing externally, right? So kind of it's a key comparability consideration. And so as you're thinking about what your transition is, how you transitioned, think about that, document what you've done, why you've done it, right? Because it's the story and sort of the overall support that you're doing that I think will, at the end of the day, kind of help with your transition and your explanation, which we always know your audits come years down the road. And so having that documented today, right, even if it's not perfect, to kind of tell your story will be very helpful, I think, in your overall achieving the objective of trying to do this transition. So with that, I just want to thank Laura and Chad and all of our listeners for joining today. And we hope that this was useful. And if you have any questions, please do not hesitate to reach out.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.